Your biggest expense is not your car, it's not food, it's not utilities, it's taxes. Good old taxes. And Uncle Sam wants his money and he wants it on time. But there are several different strategies that you can utilize before the end of the year in order to lower your tax bill and boost your refund. Let's talk money. Now, before we begin, I do want to point out that I am not an accountant and this is not tax advice. You should speak with your own tax advisors to discuss what is best for you. Now, when wondering how to boost your refund, you should think of it in 3 ways. 1, how can you defer income? 2, how can you take advantage of credits and deductions that may be available to you? And 3, how do you make sure you're hitting all the year-end tax deadlines? Number 1 is a SEP IRA. There are several different types of retirement accounts that are geared to help people save up for retirement. Most people are familiar with traditional and Roth IRAs. For individuals with a traditional IRA, one of the primary benefits is you get to receive a tax deduction for the contributions you make within the year. On top of that, your growth is 100% tax deferred, which simply means you will not pay taxes until you actually pull the money out for retirement. But for business owners, there is something even better, which is called a SEP IRA, or Simplified Employee Pension. With a SEP IRA, as long as you are issuing yourself a paycheck as if you are an employee, you can have your LLC contribute to your personal SEP IRA account, and every dollar that the LLC contributes to that account will be counted as an expense for your business, just as if you were paying another employee, although you're really paying yourself. And unlike traditional and Roth IRAs, which have a maximum contribution limit of $6,000 per year, with a SEP IRA, you can contribute up to 25% of the employee's salary, or up to $61,000 for 2022 or $66,000 for 2023. So here's a quick breakdown. Let's say your business made $200,000 this year, and of that $200,000, you paid yourself $100,000. Your business can contribute up to 25%, or in this case, $25,000 of the salary it paid you. That $25,000 would then become a tax deduction for your business and lower your tax bill considerably. All of these great benefits on top of your investments growing tax deferred is all the reason to open a SEP IRA today. Reduction in taxable income, tax deferred compounding, and high contribution limits are all practical ways to save for retirement. Number 2, finding business-related expenses. Now listen to what I'm saying and listen closely. With what I'm about to say, I am by no means necessary telling you to cheat the system. Because in a battle between the IRS and you will not win. Now that we got that out the way, most of the extracurricular activities you do in your personal life can likely be linked to your business in some way, shape, or form. Let me give you an example. I recently took a trip to Baltimore to catch a Baltimore Ravens football game. Since I own a photography company, I booked a photo shoot in Baltimore on Friday, the day I arrived, and I also booked a different photo shoot on Monday, the day I departed. Since I was involved in several different business-related activities, my travel, which included flights, hotels, and rental cars, can all be written off as an expense for the business. And not only that, I met with the customers at a restaurant in order to show them their images and sell them prints. I pay for both my meal and theirs, which will allow me to use those meals as an expense as well. Number 3, filing as an S Corp. This isn't exactly an end-of-year tax strategy. This is something you can do at any point during the year, but it's a major way to save on self-employment taxes. As an LLC taxed as an S corporation, the self-employment tax, which consists of Social Security and Medicare, is calculated based on how much you pay yourself. But any money made from the business above what you paid yourself is not subject to self-employment tax. And the amount of money you paid yourself is considered an expense for the business, just like if you paid any other employee. This will save you a huge amount of money, huge as in a savings of 15.3% from the self-employment tax. Sound confusing? Here's an example. Let's say David is self-employed and makes $100,000. He would owe 15.3% or $15,300 to self-employment tax. However, if David earns the $100,000 through his S Corp and pays himself, let's say $60,000, only the $60,000 is subject to self-employment tax. His self-employment tax bill would now be $9,100. Now, if we compare that to his $15,000 tax bill before, this would save him $6,120. As the owner of an LLC, you get to determine how you want to be taxed. You might as well use the tax code to your benefit. Now, for my fellow investors, here are 3 strategies you can use to lower your tax bill. Number 1 is tax loss harvesting. Tax loss harvesting allows you to sell investments that are down in order to lower your realized gains for the year and then buy back that exact same investment. However, you will need to wait at least 30 days before you rebuy the investment. Let's take a look at a hypothetical example. Let's say you purchased Tesla stock at $250 and it's currently trading around $170 and you're down $20,000 total. While you're not convinced that the stock price will rise in the short term, you still believe in the long-term prospects of the company. If you have realized gains in other parts of your portfolio, let's say you did very well this year in trading options and you made $50,000 doing so, you could sell all of your Tesla shares in order to lower your tax bill by that $20,000 loss, therefore only paying taxes on $30,000 instead of $50,000. From there, you just simply have to wait 30 days before you buy back into Tesla. And quick side note, speaking of trading options, I will soon be launching my online course where I will teach you my exact strategy that I use to generate 6 figures a year. If this is something that you're interested in, click the link below in the description to make sure you are notified as soon as it launches so you can take advantage of all of the pre-sale discounts. Let's make this money. Number 2, know the different tax rates for capital gains. Most people hold shares for less than a year. However, the IRS frowns upon this and actually rewards people for holding shares of a company for a year or longer. Investments held for longer than 12 months before being sold are taxed as a long-term capital gain. 20% is the most you can be taxed for shares that you hold for longer than a year, whereas the tax rate is 37% for shares that are sold in less than a year. Number 3, utilize tax advantage accounts. Many people think that they can only trade in their individual account and not in their Roth or traditional IRA. You actually can, and in most cases it makes perfect sense to do so. If you trade options, you can buy and sell cash covered puts and calls. If you are trading within a Roth IRA, you'll never have to pay taxes on any of your capital gains. This year alone, I had over a 60% return in my Roth IRA while the market tanked for the entire year. But the point is, I will never ever have to pay taxes on that 60% return that I received this year. Well folks, I hope you utilize one or all of these strategies in order to lower your tax bill. Please make sure to subscribe to the channel as we have plenty more financial tips and tricks coming your way. And until next time, peace.